Now we are coming to the second session, stock analysis, that is selection of stocks to invest in Indian stock market. So you are interested in stock market and want to invest your money to grow, right? But do you know that over 90% of people lose money in stock market because they invest blindly in any stock, and most of them lose money because they do not do their research first. So in this session, we are going to discuss 8 important parameters on how to select shares to invest in Indian stock market. By following these 8 parameters, you can select a stock to invest in Indian stock market to avoid loss and make consistent return. So now let's see what are those 8 important parameters. So first one, you need to find fundamentally strong companies through some key ratios. Here we will going to discuss some important key ratios like earnings per share, price earning ratio, price to book value ratio, debt equity ratio, return on equity, price to sales ratio, current ratio, dividend yield, and second parameter, understand product or service offered by the company. Always look for a company with a long life. And fourth one, invest companies with moat, unique selling point of the company. Avoid investing in companies with big debts, management of the company, popularity of stocks. So these are the important parameters. We will see each parameter in detail. Now let us see the first parameter, that is find fundamentally strong companies through some key ratios. See, evaluating a company or judging the efficiency and the true value of a company is not an easy task. It demands rigorously reading the company's financial statements like balance sheet, profit and loss account, cash flow statements, etc. Since it is tough to go through all the informations available on a company's financial statements, investor can have to found some shortcut in the form of financial ratios. These financial ratios are available to make the life of a investor comparatively simple. Using these ratios, an investor can choose the right companies to invest in, or can compare the financials of two companies to find out which one is a better investment opportunity. Now we are going to discuss 8 of such financial ratios analysis that every stock investor should know. So the first ratio is earning per share, which is commonly known as EPS. It is very important to understand earning per share before we study any other ratios, because the value of EPS is also used to various other financial ratios for their calculation. So EPS is basically the net profit that a company has made a given time period divided by the total outstanding shares of the company. Generally, EPS can be calculated on an annual basis or quarterly basis. And this is the formula for calculating earnings per share. That is, EPS is equal to total earnings. Total earnings here is nothing but net profit available to equity shareholders divided by outstanding shares, right? Okay. From the perspective of an investor, it's always better to invest in a company with higher and growing EPS, as it means that the company is generating greater profit. Before investing in any company, you should always check past EPS for the last 5 years. If the EPS is regularly falling, stagnant, or erratic, then you should start searching for another company. Next is price to earning ratio. The price to earning ratio is often called PE ratio. It is one of the most widely used financial ratio among investors for a very long time. A high PE ratio generally shows that the investor is paying more for the share. And the PE ratio is calculated by using this formula, that is PE ratio is equal to stock price divided by earnings per share, that is EPS. For example, a company with the current share price of 100 rupees, right, and EPS of 20 will have a PE ratio of 5, right? Okay, so as a thumb rule, a low PE ratio is preferred while buying a stock. But however, the definition of low varies from industry to industry. Different industries like automobile, banks, IT, pharma, etc. have different PE ratio for companies in their industry. Comparing the PE ratio of the company of one sector with the PE ratio of the company of another sector will be insignificant. For example, it's not much use to compare the PE ratio of automobile company with the PE ratio of an IT company. However, you can use the PE ratio to compare the companies in the same industry. So, always prefer the company which is having low PE ratio. Next is price to book ratio. Price to book ratio is calculated by dividing the current price of the stock by the book value per share. Here, book value can be considered as the net asset value of a company, and which is calculated as total assets minus intangible assets and liabilities. So here intangible assets are like patent, goodwill, trademark, etc. And this is the formula which we use to calculate price to book ratio, that is price per share divided by book value per share. See, price to book ratio is an indication of how much shareholders are paying for the net assets of a company. Generally, a lower price to book ratio could mean that the stock is undervalued. However, again the definition of lower varies from industry to industry. There should be an ample to ample comparison while looking into price to book ratio. The price to book ratio of an IT company should be compared only with price to book ratio of another IT company, not any other industry, right? Another important financial ratio that an investor should consider before selecting a stock of a company, that is a debt to equity ratio. Debt to equity ratio measures the relationship between the amount of capital that has been borrowed, that is nothing but debt capital, and the amount of capital contributed by the shareholders, that is equity capital. Right? Okay. This is the formula which we use to calculate debt to equity ratio, that is total liabilities borrowed capital divided by total equity, that is nothing but owned capital. Generally, as a firm's debt to equity ratio increases, it becomes riskier, as it means that the company is using more leverage and has a weaker equity position. See, always if a company is having more debt, it represents more obligations for the company. Whether the company is making profit or not, it has to pay regular interest to its debenture holders and other debt instruments. Whereas equity, here if company made any profit, it has a choice. Either it can distribute that profit among its shareholders, or it can retain that money for their reinvestment purpose. So, as a thumb of rule, companies with a debt to equity ratio of more than 1 are risky and should be considered carefully before investing, right? Next ratio is return on equity ratio. Return on equity is the amount of net income returned as a percentage of shareholders' equity. And the return on equity measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. In other words, return on equity tells you how good a company is at rewarding its shareholders for their investment. And this is the formula which we use to calculate return on equity. So net income divided by shareholders equity into 100. It is always represent in percentage, right? As a thumb rule, always invest in a company with the return on equity is greater than 20% for at least the last 3 years. And year on year growth in return on equity is also a good sign. Next is price to sales ratio. The stock price to sales ratio measures the price of a company's stock against its annual sales. And price to sales ratio is another stock valuation indicator similar to your price earning ratio. And the formula for calculating price to sales ratio is market value per share divided by sales per share. And price to sales ratio is great tool because sales figures are considered to be relatively reliable, while other income statement items like earnings can be easily manipulated by using different accounting rules. Next is current ratio. The current ratio is a key financial ratio for evaluating a company's liquidity. It measures the proportion of current assets available to cover its current liabilities. That is, current ratio always represents a short-term solvency of a company. That means the level of current assets that the company is having to meet its current liabilities. So that is the ability of a company to meet its short-term obligation with its current assets, right? So this is the formula which we use to calculate current ratio, that is current assets divided by current liabilities. And the ideal current ratio is 2 is to 1. That is, here 2 represent your current assets, 1 represent your current liabilities. That is, every 1 rupee of your current liability, the company should have at least 2 rupee as current assets, right? Again, this ratio is differ from industry to industry. For financial industries, banks and all, the ideal current ratio is 1.5 is to 1. That is, 1.5 represent current assets, 1 represent current liability. So before investing in a stock of any company, you should check its short-term solvency. So every company should have more current assets than its current liability, right? So that you should check before investing your money in any company. The last and final ratio is dividend yield ratio. A stock dividend yield is calculated as the company's annual cash dividend per share divided by the current price of the stock and is expressed in annual percentage. And mathematically, it is used to calculate like this, that is annual dividend per share divided by current share price into 100. For example, current share price of a company is you just imagine 100 rupees and it is giving dividend of rupees 10, then the dividend yield will be 10%, right? A lot of growing companies do not give dividend, rather they reinvest their income in their growth. Therefore it is totally depends on the investors whether he wants to invest in a high or low dividend yielding company. Anyway, as a thumb rule, a consistent or growing dividend yield is a good sign for an investor. Therefore, you should select, as an investor, you should select a dividend paying company for your investment. So these are the some important key ratios to assess the financial strength of the company and whether the company is fundamentally strong and whether the company is worth investing or not. And don't worry much about calculations of these ratios. All these financial ratios are easily available on various financial websites. And now the website we can use for fundamental analysis is screener.in. So before getting to the screener.in website, let us recall that that is EPS of the company should either remain constant or it should increase. And one more thing, that is the company that you select for your investment should be a dividend paying company, and the debt to equity ratio should be less than 1, or it should even less than 0.5 is also a good thing, because company should not have more debt. It always represent company's obligation. If company is having more debt, it's all majority of its profit will goes on paying interest. So that's why that you should check. And return on equity and return on capital employed should be greater than 15% and even more for last 10 years. So these are the few things that you should recall while analyzing the financial strength of a company. Okay, let's get into the screener.in website. Okay, let me type screener.in. So if you click on this first one, so you will get a page like this. So here you can search for a company. So let us search for Hero Moto company. Okay, so you will get a complete information about this company. See, market capitalization of the company, that is more than 50, it is 55,208 crores. It's a good thing. It's a large cap company, and current share price is 2,763. Share high and low price they have given, and PE ratio it is only 19.8, and book value they have given. Dividend yield ratios 3.26. Okay, return on capital employed it is more than 20%, 15 to 20%. See, it is 24.2%. It's a good thing. And return on equity it is more than 15%, that is 18.7. Okay, face value they have given, and EPS of last year it is 146 rupees. It's a good thing. And debt to equity ratio, it is company is having very less debt. It is a good sign for the investor. Okay, and this is the chart of the company month. You can analyze share price using this chart, and let us see pros and cons. See, the company is almost debt free. It's a good thing. Debt equity ratio is very less, so company is having very less debts, so it is a good thing for an investor. And the stock is providing a good dividend yield. Okay, dividend yield ratio is good, and company has a good return on equity track of 3 years, that is 22.25%. It's a good thing. And a company has been maintaining a healthy dividend payout of 57.26%, so it is also a good thing for an investor. And there is a con. What is that? Let's see. The company has delivered poor sales growth of 1.70% over past 5 years. So sales growth is less, and here peer comparison is there, so you can compare this particular company with its competitors. So market capitalization, Euromoto company is having more market capitalization when compared to its competitors. And PE ratio, it is having low PE ratio. So whenever you are selecting a company for investment, you should invest a low PE ratio. You should invest in a company which is having low PE ratio. And Euromoto is having low PE ratio when compared to other competitors, right? And dividend yield is also more here, and market capitalization, it is 55,000. So that is not much, because anyway it's a large cap company. And the net profit they have given, it's a good thing. So return on capital employed 24.18% is there, and quarterly results, that is profit and loss statement is there, so that you can check its profitability. Balance sheet is there, you can check its financial position of the company for last 5 to 6 years, right? And the cash flow statement they have given, right, that you can check. And the ratios, return on capital employed, it is almost more than 24%. So it is, see, in the year 2015 it was 50%. So but still, even in the year 2021 also, it has maintained more than 20%. It's a good thing. And shareholding pattern, this is also most important thing. So promoters holding is 34.63 in the year 2018, and same, almost they have maintained the same level, like same percentage of shareholding. See, with respect to this promoters holding, one thing you should remember: if the promoters are holding more shares in their company, it always represents the stability as well as the promoters' confidence in their own business. That is why at least they should hold a 35 to 40% of shareholding in their company, right? So this is how you can analyze a company using this screener.in website. Now let us understand the second parameter, that is second steps in stock analysis process, that is understand products or services offered by the company. After filtering the companies based on their financial fundamentals, you need to investigate the company's business next. Understand the company's business model, learn about its products and services. It is important that the company is easy to understand and has a fairly straightforward business model. You might ask why it is so important to understand the company. Okay, let's understand this with an example. Assume that you have to choose a classmate for whom you will be paying for 36 months of expenses. In return for this, he or she will give you a quarter of his or her earnings thereafter for the rest of their lives. So whom will you choose? While choosing, you must be thinking to select the one who is most likely to have a great income in the future. Further, will you choose a guy or girl randomly whom you know nothing about? As you don't know the person, there is no way that you can predict how much he or she will earn in the future. The same goes for the stocks. If you can understand the stock, you can easily make an informed decision whether to buy, hold, or sell the stock at any time. Hence, always invest in the company that you understand. The next step is to ask about the future of the company. Always look for a company with a long life. Such companies have a huge growth potential and the power of compounding applies to such companies, right? And avoid investing in companies have life of just few years. For example, do you think people will be using soaps 20 years from now? The answer is yes. It's been there for over 100 years and will surely continue in the future. So maybe the fragrance will change, but the soap will be there, right? And now take another example. What do you think about pen drives? Do you think that people 20 years from now will still use pen drives? The answer might be no. Overall, select only a stock to invest in the Indian stock market that will last for the next 15 to 20 years. Next parameter is invest in companies with moat. This concept of moat was popularized by Mr. Warren Buffett. A moat is a deep, wide ditch surrounding a castle, fort, or town, typically filled with water and intended as a defense against attack. Some stocks have a similar moat around them. That's why it's really tough for its competitors to defeat them in its sector. For example, Maggi, which is from Nestle company, it has become such a common name in Indian homes that Maggi is considered as a synonyms to noodles. Another example is Colgate, so the toothpaste producing company. This company is dominating its industry, and the people simply want to buy Colgate toothpaste, right? And the third example, similarly, Maruti Suzuki. It has got a moat in the passenger car sector. Maruti Suzuki has been dominating in the Indian car sector with over 50% of market share for the last few decades. In addition, while selecting an unbeatable moat, look for such companies in which the switching cost is high. For example, banks or IT companies. How rarely people change their bank accounts just because the competitor is giving 0.1% more interest rate, right? Okay, Coal India, ITC, IRCTC, etc. are a few of the other Indian companies with a big moats. Next, the fifth parameter is find the unique selling point of the company. That is, learn what the company is doing which its competitors are not doing. To understand this better, let us analyze the Indian automobile sector. There are a number of automobile companies in India. However, when we consider the passenger vehicle, that is cars and SUVs, Maruti Suzuki is the leading company in India. There are number of Indian and global competitors against Maruti in this sector, like Tata Motors, Hyundai, Honda, Ford, etc. However, they have not been able to break the Maruti's moat. Maruti Suzuki is dominating because of its cost advantage and easily available service center that it provides. And most of the competitors of Maruti are not able to compete in its selling price. Further, Maruti service center can be found on every corner of the streets. It's really simple and easy to get a Maruti car serviced even in small cities, and that too at a little price. On the other hand, try to get your Ford car serviced, you will rarely find any authentic Ford service center around you. That's why people prefer buying Maruti cars in India. And hence, Maruti Suzuki is able to increase its sales consistently and give good returns to its shareholders. So, investigate first what the company is doing that its competitors are not before you select a stock to invest in Indian stock market. Whether you are investing in a banking sector, tires, there will be many companies and competitors. Find out the USP, that is unique selling point of the company in which you are interested to invest. Next parameter is avoid investing in companies with big debts. Big debts in a company are same as the big hole in the boat. If the hole in the boat is not filled soon, then it won't be able to cross the long sea and will definitely sink in between. So before you select a stock to invest in Indian stock market, read the balance sheet to find out the debts on the liability side, right? And avoid investing in companies with big debts. Further, while investing the companies in the banking sector, look for its non-performing assets and avoid investing in the banking sector with huge non NPAs, that is non-performing assets. Now the seventh parameter is management of the company. The management is the soul of the company. Good management can prosper the company to new heights. On the other hand, bad management can lead to the downfall of the company. It's really important to research carefully about the management of the company that you are planning to invest in Indian stock market. First, do some research and find out who is running the company. Among other things, you should know who is its CEO, CFO, MD, and the CIO, or along with their qualification and past experience. And we can check the efficiency of the management through its strategy and goals, length of tenure of the management, promoters buying and share buybacks, perks and compensation to staff and workers, financial ratios like return on equity and return on capital employed, transparency, that is the integrity of the management. So we will see each of these points in detail now. So the first point is strategy and goal. Go through the vision, mission, and value statement of the company. That will help and communicate the company's purpose, and it will inform the goals and objectives set to determine whether the strategy is on track or not. And these defined future statements for the company can help an investor to decide whether to select a stock to invest in Indian stock market or not. So the next point is length of tenure of management. So this can help to judge the stability in the management of the company. A long length of tenure of the top management with the steady growth of the company is a good sign for an investor. Next point is promoters buying and share buyback. The promoters of the company have the best knowledge about the company's performance. The management and the top officials can understand the future aspect of the company. And if they believe that the company will outperform in the future, they are mostly correct. Therefore, promoters buying and share buybacks are signals that the owners trust in the future of the company. And it's a good company to select a stock to invest in Indian stock market. In addition, the other scenario where the promoters or CEO is selling the stocks is an independent activity and cannot be treated as a bad signal. We cannot judge the company future is in the dark just because the promoters are selling some small portion of their stock once in a while. Maybe the promoters need money to start other venture, or they want to buy a new house. Everyone has the right to sell stock when they need money. So the promoters buying and share buybacks are signals of a good company. However, we cannot judge the company's future based on just the promoters selling little stock. And please note, if the promoters are selling a lot of stock continuously without explaining the reason, then it's a matter to investigate further. Next is perks and compensation to staff and workers. If the company is giving good perks to its staff and employees, then again it's a sign of good management. The result of a company depends a lot on the performance of its staff and employees. So happy employees will give their best performance, right? However, if there is a continuous strikes and increasing workers union demands, then it means that the management is not able to fulfill the needs of its workers and employees. So such cases are bad sign for investors in the company. Next is financial ratios. See, the management's efficiency can also be judged using a few financial ratios, such as return on equity and return on capital employed. About return on equity, as we have already discussed, it is the percentage expression of a company's net income as it is returned as a value to shareholders, right? So whereas return on capital employed is the primary measure of how efficiently a company utilizes all its available capital to generate additional profits. So a high and steady ROE and ROCE for the last few couple of years is considered as a sign of good management. So as a thumb rule, invest only in such companies with the ROE and ROCE of above 15% continuously for the last 5 years. Next is transparency. This is the last but one of the most important factor while judging the management. The integrity of the management is the key to the growth of the company, and it's the management duty to be fair and announce the quarterly and annual results to its shareholders honestly without any manipulations. So, just as the management take the credit to announce the good results of the company, in the same way, the management should come forward in times of bad results to explain the reasons for its poor performance to its shareholders. So, good management always maintain transparency of its organization. And now the last parameter is popularity of stock. See, the stock market is based on the sentiment of the people. Popular stocks that are consistently in news affect the expectation and decision of the public. So these stocks can be inflated by the hype of the media. As people expect greater results from such companies, even after giving the good returns, the stock prices of such companies may fall. That's why I try to avoid buying stock of such companies for easy returns. So the odd stocks are more subjected to market volatility, and the boring stocks are the one which gives the best returns. So these are the key points to consider while choosing a stock to invest in Indian stock market.